Hey guys, it's Charlie Cameron. I thought you might want to learn about why I love investing in real estate so much, so I'm just going to run through quickly the 11 unfair advantages of real estate investing, that specifically apartment investing, that I wrote a blog article about and I'll link to. But let's just get right into it. So number one is profiting monthly instead of when you sell. Unlike the majority of stock market investments, where you reap the benefit when you sell, with real estate you can get paid every single month. And then if you add equity or just equity over or appreciation over time, you can reap the benefit on the tail end when you sell as well. Number two is free equity. If you've ever owned a home and put a renter in there, you know how good it feels to have someone else paying that mortgage. So that's an awesome advantage. Number three, deductible expenses. So I don't fix toilets. People always get this impression like, why would you want to own all this real estate and be so busy? I'm not. I pay somebody else to fix toilets. Why wouldn't I if I can deduct it against the income, right? Number four is we can depreciate the entire structure over time. So Uncle Sam actually incentivizes and subsidizes rental property owners to provide safe and affordable housing to the public. And one of the ways it does this is it allows you to depreciate the entire property over 27 and a half years if it's residential. So that makes it possible to have book losses but pocket money each year, which is a pretty cool thing. Now, number five is profiting in any market. It is possible to profit in any market, but there are some things you can do that will reduce risk in your investment, such as avoiding high tax areas and avoiding luxury properties which get hit first in a downturn. The point here is to provide affordable housing to places with jobs. It's that simple. Number six is the ability to trade up tax-free. If you've ever heard of a Stark or a 1031 exchange, that allows you to defer taxes on the sale of a property when you buy a more expensive one. So you can keep doing that forever. So you can keep just growing your passive income with that initial investment by trading up into bigger properties. And it doesn't have to be apartments to apartments. If you have a rental house, you can trade that up for apartments. You can trade that up for a short-term rental. There's so many possibilities with this. That's my plan for my 24 apartments that I own in two separate LLCs. I plan to just keep trading those up over time to increase that passive income and replace some W-2 income. Now, number seven is economies of scale. So, multiple units under one roof. We're not talking about a single family house where, when the renter leaves, now you're stuck paying the bill for, 2 months, 3 months. You got repairs. It's going to take a while to find renters. With apartments, one unit can go vacant, everything else still runs. You can still pay all the bills. Multiple units can go vacant, you can still pay all the bills. Plus, when you have scale, you have lots of units in one location. You only have one roof. You can reduce your expenses. You can pay less for services. You can pay less for property management. So those things just kind of snowball continuously as properties get bigger. Number eight is more tax write-offs, right? So if you own rental property and you want to go visit it, you want to go talk with your property manager, you want to go make repairs yourself, you want to go oversee some stuff, your meals, your travel are deductible. The office you work in on rental properties can be deductible. Half your phone bill could be deductible. There's lots of things you can look at with a professional CPA to deduct now because you're using those things for your business. Number nine, value add can equate to massive returns. What do I mean by that? Let's say you buy an apartment where the rents are $100 below market per door, and it's 10 apartments. Now you raise all those, and you raise the value by a lot. Just on my properties alone, if my rent goes up $10 a door, the value goes up $1,500 when I sell it. Okay, that's called forced equity or forced appreciation. So I have control, and I can add value to properties, which I can't do to any stocks I buy, right? So that's a pretty cool thing. Now, do that for tens of apartments, $150 a door, you do that math, and that phantom equity grows really quickly. Something else you could do, which is number 10 on the list, is refi tax-free. So let's say we added a bunch of value, but now the market's kind of wonky. We could refinance out all that extra value we added, use that money to buy another property, and hold the first one instead of having to sell low. And now we're at an advantage because we can buy low, right? So that's pretty cool too. And then the last advantage is cost segregation. This is going back to tax depreciation, depreciating the property, but now you do a legitimate engineering study, which is encouraged by the IRS, and after some analysis, you can basically write off a lot of the property up front, things that do depreciate faster than the standard 27.5 linear depreciation you can take. So now you can write off about half the property or so on average over the first 5 years, and then write off the rest over the other 22. So that's huge gains up front, less taxes up front or no taxes up front. Potentially, you can pocket a lot more up front and then go do it again. So anyway, those are the 11 advantages. I hope you liked this video. I wanted to shoot it outside, but the weather's not cooperating. It's raining, it's windy. I will hopefully do the next one in front of an apartment complex because I think that's cool. And go Hoos. See ya.